Despite the passing of the Holding Foreign Companies Accountable Act and the delisting of 17 Chinese companies as a result of the executive order that bans securities linked to the Chinese military, Chinese companies are still rushing to the U.S. stock markets, and they might have found a new way to bypass congressional scrutiny. Hi everyone, welcome to Lei's Real Talk. I'm Lei. China wants to take advantage of the U.S. capital market to fuel its growth. In my last video, I talked about the record number of Chinese companies that went public in the U.S. last year and gave a few noteworthy examples. This trend is continuing. Vera Yang, China Chief Representative for the New York Stock Exchange, estimated that 60 Chinese companies are planning to be listed in the U.S. stock market this year. Other than the traditional IPO, the Chinese have discovered a new way to raise capital quietly without getting too much attention. It's called SPACs. A special purpose acquisition company, or SPAC, is a company formed strictly to raise capital through an IPO for purchasing an existing company. They're known as blank check companies and don't have a commercial operation. They are shell companies that exist for the purpose of acquiring another one. The founders of a SPAC usually have acquisition targets in mind, but don't have to identify them during the IPO process. This allows the SPAC to raise capital without disclosing targeted investments. The money a SPAC raises in an IPO is placed in an interest-bearing trust account. The funds cannot be disbursed except to complete an acquisition within 2 years, or it will be returned to the investors. SPACs have existed for decades, but recently have been gaining popularity. Mick Schwartz, a professor at the University of Southern California, pointed out that retail investors are hoping to participate in the initial growth of large companies, and SPAC provides that platform. This is the main reason for the surge in SPACs. The Chinese quickly took note of the needs of American investors, and most importantly, the convenience that SPACs offer in keeping investment targets relatively anonymous. And they have seized the opportunity. A major Chinese finance magazine, Caixin Weekly, published an article in early March titled SPAC, the Carnival of a Magic Box, with the subtitle, Leveraging 25,000 Investment 1,000 Times. SPAC, the blind box that got the big shots excited, has arrived. The article said that Chinese companies' passion for overseas SPACs are surging and unstoppable. Let's take a look at some Chinese SPACs. This past March, a SPAC backed by HONY Capital, one of China's biggest private equity firms, filed to raise $300 million on NASDAQ to invest in technology-enabled Chinese companies in healthcare and consumer products. Founded in 2003, HONY Capital has close ties to the Chinese regime. It is a subsidiary of Legend Holdings, which owns Lavono Group. Legend was established by and is affiliated with the Chinese Academy of Sciences, which is the official research institute and scientific think tank of the Chinese government. HONY is widely known in China as the expert in the restructuring of state-owned companies. According to its own publicity, it has led the restructuring of 33 state-owned enterprises, including China Glass and China National Cereal, Oil and Food Corporation. HONY has also helped them deploy global strategies through partnerships and mergers and acquisitions. For example, in 2008, HONY assisted China's second-largest manufacturer of agriculture machinery, Zoomlion, in purchasing an Italian equipment manufacturer, CIFA. HONY also brought in an American artificial intelligence expert, Lending AI, to help Zoomlion expand its smart agriculture program. HONY is not only well connected to the Chinese government, but also well connected outside China. Its investors include Canada Pension Plan, New York State Common Retirement Fund, Kuwait Investment Authority, the Bill and Melinda Gates Foundation, and Goldman Sachs. In an article by Voice of America, a Chinese investment expert based in New Jersey, who only disclosed his name as LT, said that the percentage of HONY projects being listed on Chinese exchanges is as high as 21%. In China, where listings need to be queued for licenses and approval, this high listing percentage shows that HONY's relation to the Chinese authorities is exceptionally close. Mr. LT also said that HONY's listing in the U.S. through its SPAC will bypass the Congress's review of foreign companies' listing in the U.S. and may bring the risks of Chinese capital into the U.S. market. He said that the HONY transaction may also introduce ideological issues. The title of that VOA article is the SPAC HONY backs aiming to raise capital or evade audit review? Guo Wen, the general manager of HONY's fund company, said in a 2018 interview that HONY is optimistic about investments in national strategic sectors such as 5G and the military industry. HONY's experience in state-owned enterprises makes it the perfect private equity firm to help the Chinese government raise funds in sensitive industries. HONY is not alone. Other Chinese SPACs backed by private equity firms that have close relations to the top levels of the Chinese government include Primavera Capital, which raised $360 million in New York Stock Exchange, is interested in global consumer brands with a significant China presence. Hopu Investments HHL acquisition company, which raised $414 million through a NASDAQ IPO, will target healthcare companies with a China focus. The SPAC established by CITIC Capital, which is Chinese state-owned, raised $280 million with the intention to invest in the energy efficiency, clean technology, and sustainability sectors. For American retail investors, you need to be aware of the risks involved with investing in a Chinese SPAC. The return may not be as good as you think, and the risks are certainly uncontrollable. HONY's annual return has been only about 7%, which is below the industry average of 10%, and certainly much lower than the Chinese average. The biggest risk is national security. The CCP is taking full advantage of the American capital market to grow itself. If our money inadvertently helps build the Chinese military, it's not a matter of return on investment anymore. That's all for today. Stay tuned. I'll keep you updated on future development. Like and share my videos, and I'll see you next time.